If your business has a fire that interrupts operations, are you covered for that? Your employees still need to get paid if you want them to come back, and that's assuming your policy includes payroll coverage, which not all of them do. Your loan payments don't stop. Your suppliers don't care that you had a fire. The bills keep coming and the revenue doesn't. Do you know whether your insurance covers that gap? That's what we're going to talk about today. Business interruption coverage, how it actually works, what triggers it, and why the details matter more than most people realize. My name is Jim Eddington, and my agency helps business owners navigate these kinds of situations every day. Let me walk you through how this plays out in the real world. So the first thing to understand is what business interruption coverage actually is designed to do. And the easiest way to think about it is this. Your commercial property policy covers the physical stuff, the building, the equipment, the inventory. Business interruption coverage picks up where that leaves off. It covers the income your business would have earned during the time you were shut down for repairs, and it covers the ongoing expenses you still have even though you're not operating. The goal is to put you in roughly the same financial position you would have been if the loss had never happened. Not better, not worse, the same. Now, that sounds straightforward, but in practice, there are a few moving parts that determine how much you actually receive and when. The first one is the trigger. Business interruption coverage doesn't kick in just because your revenue drops. It requires a direct physical loss to your property from a covered cause, a fire, a windstorm, a burst pipe, whatever your policy covers. If your business loses revenue because of a slow season or because a competitor showed up down the street, or because there's road construction blocking your entrance for 3 months, that's not a business interruption claim. The coverage is tied directly to physical damage to your insured property. This is an important distinction because a lot of business owners hear business interruption and assume it covers any interruption to their business. It doesn't. The interruption has to be caused by physical damage that's covered under your property policy. If the cause of the damage is excluded, say a flood in a standard policy that doesn't include flood coverage, then the business interruption that results from that flood is also not covered. The two are linked. If the property damage isn't covered, the lost income from that damage isn't covered either. Once the trigger is established, you've had a covered loss and your business can't operate normally while repairs are being made. The next thing that matters is the waiting period. Most business interruption policies have what's essentially a time deductible. It's typically 72 hours, though it varies by policy. That means the coverage doesn't start paying from the moment the loss occurs. It starts after the waiting period expires. So if your business is closed for 3 weeks, you're covering the first 72 hours of lost income yourself, and the policy picks up after that. For a business that generates a few $1,000s a day, those first 3 days can represent a meaningful amount of money, so it's worth knowing that number. Now let's talk about how the actual payment is calculated, because this is where it gets more involved. The insurance company needs to figure out how much income your business lost during the time it was shut down, and they don't just take your word for it. They're going to look at your financial records, your tax returns, your profit and loss statements, your sales history to establish what your business would have earned during that period if the loss hadn't happened. This includes seasonal variation. If your restaurant does twice the revenue in December as it does in February, and the fire happens in November, the insurance company is going to calculate your lost income based on what December would have looked like, not based on an average month. They're also going to look at your continuing expenses, the costs you still have to pay whether or not the business is open. Rent or mortgage, loan payments, utilities to some extent, insurance premiums, and payroll if you're keeping your employees on. These are called continuing normal operating expenses, and they're part of the calculation because they represent money going out the door with nothing coming in. The policy is designed to cover these so that when you reopen, you're not buried in debt from the months you were closed. There's a concept here called the period of restoration, and it matters a lot. This is the window of time during which the insurance company will pay business interruption benefits. It starts when the physical damage occurs and it ends when the property should be repaired, rebuilt, or replaced with reasonable speed. That last part is key, with reasonable speed. The insurance company isn't going to pay indefinitely. If the repairs should take 2 months, but you don't start them for 3 months because you're dealing with other things, the insurer is going to calculate benefits based on a 2-month restoration period, not 5. They're paying for the time it should reasonably take to get back up and running, not the time it actually takes if there are unnecessary delays. And on the other end of that, if you find a way to get partially operational sooner, maybe you set up a temporary location, or you're able to do some of your work off-site, the insurance company is going to factor that in too. If you're generating some revenue during the restoration period, the lost income calculation goes down accordingly. That's not the insurance company being difficult, it's just how the math works. They're covering the gap between what you're earning and what you would have earned. And if that gap gets smaller because you found a way to keep some revenue coming in, the payout reflects that. Now, let me walk through what this looks like at different scales, because a coffee shop and a manufacturing operation are dealing with very different numbers. Say you run a very small coffee shop. You do about $15,000 a month in revenue. You have a fire in the back. It's going to take 6 weeks to repair. During those 6 weeks, you're still paying your lease, maybe $3,000 a month, your insurance, your loan payment on the build out, and ideally you're keeping your 2 employees on some kind of pay so they don't go find other jobs and you have to hire and train all over again when you reopen. Your business interruption coverage is going to look at what you would have made during those 6 weeks. Subtract the expenses you're no longer incurring because you're closed, like cost of goods, variable utilities, and you pay the difference. Plus cover those continuing fixed expenses. For a small operation, this might be a claim in the range of $20,000 to $30,000. That's not a huge number in the abstract, but for a small coffee shop owner, it's the difference between reopening and not. Now scale that up. You run a small manufacturing shop, you do $150,000 a month in revenue. You've got 12 employees, expensive equipment, raw materials, active contracts with delivery deadlines. A fire shuts you down for 3 months. Your lost revenue over that period is $450,000. Your payroll alone might be $60,000 or $70,000 a month. Your lease on a manufacturing space could be $10,000 or $15,000. You've got equipment loan payments, insurance, utilities, and on top of that, you may have structural penalties for missing delivery deadlines with your customers. Those penalties themselves usually aren't covered directly, but the lost income from being shut down is. The business interruption claim on something like that can easily be in the hundreds of thousands. If the policy limit isn't set high enough to cover the actual exposure, you're absorbing the rest yourself. That brings up one of the most important and most overlooked parts of business interruption coverage, the limit. When your policy was written, someone selected a business interruption limit. That limit is supposed to reflect 12 months of your business income plus continuing expenses. But a lot of business owners pick a number that felt reasonable at the time and never revisit it. If your business has grown since the policy was written, you've added employees, your revenue has gone up, your expenses have increased, that limit might be significantly below what you'd actually need. And unlike property coverage, where you can see the building and put a number on it, business income is harder to estimate, so it tends to be underinsured more often. There's also something called extra expense, which is often included alongside business interruption or available as an add-on. This covers the additional costs you incur specifically to keep operating or get back to operating faster. If you rent a temporary space while yours is being repaired, that's an extra expense. If you pay overtime to contractors to speed up the rebuild, that's an extra expense. If you have to rent equipment to fill orders while your equipment is being replaced, that's an extra expense. This coverage exists because sometimes spending more money to get back open sooner actually reduces the total business interruption loss. The insurance company has an incentive to support that because a shorter shutdown means a smaller income claim. One more thing that's worth understanding is how business interruption interacts with your specific type of business. A retail store that depends on foot traffic is different from a service business that might be able to operate remotely. A restaurant that needs a physical kitchen is different from a consulting firm that just needs laptops and internet. The impact of a physical loss on your revenue depends entirely on how dependent your business is on its physical location and physical equipment. A fire in a consulting firm's office is disruptive, but the consultants can probably work from home or a co-working space within a few days. A fire in a machine shop is catastrophic because the entire operation depends on equipment that takes months to replace. Your business interruption coverage should reflect that reality. So here's where you should be after hearing all of this. You should know whether your commercial property policy includes business interruption coverage, because not every policy does automatically. Sometimes it's included. Sometimes it's a separate coverage you have to add. You should know what your limit is and whether it actually reflects your current revenue and expenses, not what they were 2 or 3 years ago when the policy was written. You should understand that the coverage is tied to physical damage from a covered cause, that there's a waiting period before it kicks in, and that the period of restoration has limits tied to how quickly repairs should reasonably be completed. And if your business is the kind that lives or dies by its physical location and equipment, this is one of the most important coverages on your entire policy. If you want help figuring out whether your business interruption coverage actually matches your current operation, whether the limit is right, whether you've got the extra expense coverage, whether the whole thing is structured for how your business actually runs, that's exactly what we do. We work with business owners in Arizona, California, Nevada, and Utah. There's a link in the description. You can get a quote and we'll help you figure out exactly where you stand.